In this video, we will continue our discussion of consolidated financial statements after acquisition by covering an example using the equity method to consolidate financial statements in year 2 after an acquisition. In our previous video, we completed an example in which we had to determine the eliminating entries that would be used to consolidate at the first year end following acquisition. Now we're going to move forward down our timeline and consider any differences between the first year end consolidation and the second year consolidation and all of the subsequent consolidations thereafter. As you can see from the graphic, we're adding a few new things to our second year consolidated year end, but not too much has changed in general. So during the course of that second year, we would again, as the parent company, record any changes to investment in S under the cost or the equity method. And then we would, of course, need to still eliminate our initial investment in S, any intercompany transactions, and any current year changes in our investment in S. But the thing that's new is that we're also going to have prior year changes to investment in S. And those are going to manifest themselves in retained earnings. And so what we're going to need to do is we're going to need to take into account the fact that we had prior year investment income and prior year dividend income, depending on if we use the cost or the equity method. And where that ended up on the parent general ledger is probably not where we want it on the consolidated financial statements. So we're going to need to make an extra adjustment there. As you can tell in our actual reporting, we don't have any new financial statements because we've already done a full year end with all of our financial statements. So we've already had to prepare a balance sheet, an income statement, a retained earnings statement, and a statement of cash flows. That's all the statements there are, so there aren't any that can be added at this point. So our eliminating entries for year 2 and beyond are going to follow the same 5 steps that we used for the first year. First step is going to be eliminating intercompany transactions, including any current year dividends. Then we're going to eliminate any investment income if the parent company used the equity method. That only applies to the equity method. Then for number 3, we're going to establish reciprocity. This is only for the cost method starting in year 2. We are doing a year 2 example, but it's going to be equity method, so we're still going to hold off on this. We'll come back to it. And then for number 4, we're going to eliminate our subsidiary equity. And number 5 is going to be allocating that difference between implied and book. So these entries are exactly the same as they were in year 1, same list that we're going to go through. But some of the numbers are going to change necessarily because the company has been doing business throughout the year and their balances on their general ledger accounts will have changed. So in this example, we are continuing the situation that we did in the previous video, and they've given us a little bit of additional information, which is to assume that during 2015, sales company earned $190,000 and declared and paid a $50,000 dividend. Now, you'll notice that our computation and allocation of differences schedule is already completed here. That's because I linked it to the previous example. The computation and allocation of differences schedule is prepared on the date of acquisition, and once our measurement period closes and all of our fair value measurements are done, this is set in stone. And so this does not change. This is a historical document prepared as of the date of acquisition. So we only have to prepare this once for an acquisition, and then we just refer back to it in subsequent years. The first thing that they ask us to do for this question is to prepare the investment related entries on per company's books for 2015. Now, this is again, remember, we're putting these on our parent company's general ledger, and they're asking us to do this not because it's important to the actual consolidation, but because it helps inform us about what our eliminating entries should be and helps illustrate why we're doing the eliminating entries that we are. So none of this is new. You learned all of this in the investments chapter. And so again, what we need to know is whether our parent company is using the equity method or the cost method to account for their investment. And in this example, they are using the equity method. So that's what they used last year, and they will continue to do so throughout the course of this investment. And so for our equity investments, what we're going to do is we are going to record changes to investment in S as if it is our own little mini retained earnings account. So it's going to increase for positive income, decrease for dividends, or decrease for negative net income or a loss. Okay, so they said they had $190,000 of positive income. So that's going to increase the value of our investment. So we're going to debit investment in S. And the amount here is going to be that $190,000. That's the total amount of net income recorded. by our subsidiary times our ownership percentage, which is the 85%. Then our credit here is going to be investment income, but remember in the book that we're working with now, they call that equity in S income. Okay. Then we need to record any dividends that the parent received from our subsidiary. And so our subsidiary paid a $50,000 dividend. And as we are an 85% shareholder, that means that 85% of those dividends did come to us as the parent. So we would have gotten a check in the mail. So we're going to debit cash. And that check in the mail would have been for $50,000 times our ownership percentage, or $42,500. Then because this is the equity method, we're going to record this as a decrease to our investment in S. We're acting as though it is a return of our investment. So we're going to credit investment, in S for $42,500. So the next thing they ask us to do is to prepare the work paper eliminating entries for a work paper on December 31st, 2015. That's our second year end. Now, before we do that, I'm going to add in this little extra activity here that is not asked by the problem for us to do it. However, it's sort of like the computation and allocation of differences schedule, where if you just get used to doing it and make a habit of it, it makes your life so much easier, especially in these problems where they're giving us kind of like snippets of information as opposed to the real world where you would be working with this company year over year and you would have a good idea of their operations. So what we're going to do is we're going to put together a little retained earnings roll forward. This is basically a statement of changes in retained earnings. And so on our date of acquisition, which was 1/1 of 2014, our subsidiary had a retained earnings balance of $140,000. That's memorialized in our CAD. Then last year, we're going to have to go back to our other example. Last year, our subsidiary recorded net income of $148,000 and a dividend of $50,000. So we're going to take that $148,000, we're going to put it here. $148,000. And we're going to take out that $50,000 dividend. And so again, our ending retained earnings balance is going to be our beginning balance plus net income minus any dividends declared. So again, we're just making a little roll forward for our subsidiary, and that's why this is blue, because this is all information coming out of their general ledger. Then our beginning balance for 2015 is going to be the same as the ending balance of 2014. And then here, again, they told us net income for this year was $190,000, and again, they issued a $50,000 dividend. So that's $190,000 for their net income and another $50,000 dividend. Just fix my formatting here. And then we add this up. So again, that's beginning balance plus net income minus dividends gives us our ending balance of retained earnings. Now, we're not going to need all of this information, but we are going to need some of it. And having it organized this way is going to help us keep it straight as we go along. Okay, so the first, now we're just going to work through our eliminating entry steps. The first one is to eliminate any intercompany transactions, including any current year dividends. So as we talked about last example, if you go down here, we had the recording of dividends last year, and we showed what that looks like on the parent side, and we showed what it looks like on the subsidiary side. So when we have an intercompany transaction, usually what happens is there's some entry on the parent side where we're going to eliminate half of it. And there's some entry on the subsidiary side where we're going to eliminate half of it. So we're offsetting across the two entities, and that's why it's an intercompany transaction that's being eliminated, because we're going to pretend as though that transaction didn't happen at all. So when we come over here and we look back up at our dividends, again, we don't care where the cash is. The cash can be on the subsidiary books. It can be on the parent books. It's going to get added up to the same line item on our consolidated financial statements. It's owned by our consolidated entity, so we can leave that alone. We don't need to move that. That's not bothering us. But this investment in S, we know we do need to get rid of that. So we're going to, it was originally recorded as a credit. We're going to debit it. And as we saw last example, So this is the parent side of it. On the subsidiary side of it, again, half of their entry is cash. We don't care about the cash. But the other half is dividends declared. And so you can't declare dividends to yourself. And so that's the part from the subsidiary that we're going to undo. Okay. Then number 2 is eliminate any investment income. This is for the equity method only. We are doing the equity method, so we're going to need to do this. Again, we can reference the entry we made on the parent books. And so we see that we recognized $161,500 of investment income. We don't want to recognize that on the consolidated financial statements because instead we're going to take the subsidiary's income statement and add it to the parents. So we don't need this summary of net income. We want line by line on our financial statements. So this was originally a credit. We're going to debit it to get rid of it. And also the offside, we want to get rid of investment in S. So we are going to undo that as well. All right. Then for number 3, we need to establish reciprocity. This is for the cost method only, and we are not doing the cost method, so we can skip this one. And then we get down to eliminating our subsidiary equity. And so here, again, our accounts are going to stay the same, but our numbers might change. So we're going to start by filling out the account names, and then we'll come back and fill in the amounts. So if you look up here, we know we need to get rid of our subsidiary equity. They have 3 accounts: common stock, other contributed capital, and retained earnings. They all have normal credit balances. So to get rid of them, we're going to debit them. So we have common stock of our subsidiary. We have other contributed capital of our subsidiary. And remember, the thing that was new last video was our retained earnings. We are going to designate that as 1/1 retained earnings. So as of the beginning of the period, or January 1st. Because we need to be able to prepare that roll forward or that statement of changes in retained earnings. Okay, so this gets rid of all of our subsidiary equity accounts. As I said, we're going to come back to the numbers in a minute. Then we know we also need to eliminate investment in S. So investment in S normally has a debit balance because that is an asset account. So we are going to credit investment in S. Then if our parent company owns less than 100%, we're going to need to create a non-controlling interest. So just a refresher, we have 85%. So there is a non-zero non-controlling interest. Non-controlling interest is an equity account that we're going to create. So that's going to be a credit. And then finally, we have our plug, which is difference between implied and book. And again, that is a positive number here. So we know that's going to be a debit in this entry. So even though our computation and allocation of differences schedule is prepared as of the date of acquisition, and we're now 2 years down the line, you can see we're still referring back to it. We're still getting a lot of information out of it. Okay, so the numbers that don't change are the easiest place to start. So common stock and other contributed capital won't change just because our book is nice to us. We don't get to that particular complication. So other contributed capital was $100,000 on the date of acquisition. It will still be that 2 years out. So for the whole course of this class, we're not going to get to that. Then other contributed capital was $40,000 on the date of acquisition. That will stay $40,000. Now, 1/1 retained earnings, again, I mentioned in the last video, this is going to change. It has to change unless our subsidiary breaks even exactly every year and never pays out any dividends, which is unlikely, right? They're probably going to at least make $1 or lose $1. So we're going to have to deal with that in a minute. Difference between implied and book. Difference between implied and book will change, or will not change because it is a historical number. So our difference between implied and book is calculated on the date of acquisition, and it does not change. So we can count on that one. Now, 1/1 retained earnings, again, I said, we know is going to change. And last example, we got lucky because 1/1 was the date of acquisition. And so it matched our computation and allocation of differences schedule. But here's where our roll forward comes in handy. So last year we were consolidating 2014. 1/1 retained earnings was 140,000. That happened to be our date of acquisition. So it matches our computation and allocation of differences schedule. But now we're consolidating for 2015. So our beginning balance of retained earnings is instead this number right here. So that's the one that we're going to plug in here because that's the one that needs to be eliminated. All right, now because this number has changed, you can see it's increased over time from the date of acquisition till now. We're going to need to take the difference there and allocate it between our investment in S and our non-controlling interest to make sure that this continues to balance. So nobody likes this calculation, and I apologize in advance. Okay, so what we're going to do is we're going to start with investment in S. And so we're going to start with investment in S back when retained earnings was 140,000, which was our date of acquisition. So that was $350,000. So if it's $350,000, we know our entry balances when retained earnings is 140,000. Unfortunately, it's not 140,000 anymore. So we need to add to it the incremental amount above and beyond that. So we know that it is now larger. So it's increased actually, let me reference this a different way. That'll always work for you. All right, so we're going to start with, again, our initial investment in S. And then we're going to take the difference between the retained earnings we just put into our eliminating entry minus what it was on the date of acquisition, which can always be found in our computation and allocation of differences schedule. Now, this difference here is always going to be between what we're eliminating now for this year and the date of acquisition. So right now, that's just 1 year. But if we are 10 years out, we're going to be looking at 10 years versus the date of acquisition. So this is a catch up all the way back to the date of acquisition, not just the most recent year. Then what we're going to do is we're going to multiply this by number by our ownership percentage, or the 85%. So we're taking 85% of that additional retained earnings and giving it to the parent share or investment in S. Then we're going to do the same thing for our non-controlling interest. So we're going to start with the non-controlling interest that worked when retained earnings was 140,000. We're going to add to it part of this change in retained earnings, which again is going to be the difference between retained earnings as it appears in this eliminating entry for this year, minus what it was on the date of acquisition, which is memorialized in our computation and allocation of differences schedule. Then we're going to take the remaining percentage, or the 15%, and give it to the non-controlling interest. So this amount that I have in parentheses here is the entire change of retained earnings from the date of acquisition to the beginning of the year we're consolidating. And we've given 85% of it to the parent, and now we're giving 15% of it to the non-controlling interest. So the entire thing is represented in our entry, and our entry now balances. Now, one thing I always regret saying, but I'm going to say it this one time, and then I'm going to deny it forever afterwards. Even though it's memorialized in this video and you could play it back to me, I'm going to pretend like you can't. So if you get yourself stuck and you figure this out, but this formula is just blowing your mind and you cannot handle it, for the purposes of this class, and I cannot say this will work in reality, but for the purposes of this class, these two numbers can be found by taking the sum of these, some of the debits, and taking the parent percentage and putting it here, and the subsidiary percentage and putting it here, or the non-controlling interest percentage and putting it here. That's it. I'm not saying it again. Rewind if you want to hear it again. Okay, so then the last thing we need to do is allocate our difference between implied and book. So that was a debit. We're going to credit it. Ooh. And we're going to allocate it. Where? Well, we're going to look for fair value adjustments first, then anything goes to goodwill. They told us here that the entire thing goes to land. So we're going to write up land by $131,765.